Today I want to talk to you about something that most people don't talk about for traders, and that's the impact of mistakes. A mistake I define as when you don't follow your written trading rules. And of course, if you don't have written trading rules, everything you do is a mistake. So, what do you think the most important factor or most important trait in your trading is? You'd probably say at this point, not making mistakes, but it's really a quality here that you need not to make mistakes. Well, it's what I call personal responsibility. You must believe that you're totally responsible for your trading results, that you are the most important factor and your results reflect your performance. For example, if you've lost money recently or in the crash in 2000 or the crash in 2008, why? You know, was it because of poor advice? Was it because of a terrible market? Maybe you had a fund manager who wasn't too sharp. Maybe your broker wasn't too sharp. Corrupt banking system perhaps did it to you, or corrupt CEOs, or corrupt analysts, or the media, or who knows what. Did you answer yes to any of those? Well, I hope not, because those are all sources of blame. And they cover up your mistakes. There's always going to be a corrupt CEO or a corrupt analyst or poor advice that you can blame, and it prevents you from figuring out why you did make the mistakes. What's more likely are these. You didn't have a written business plan to guide your trading. You didn't have an exit pre-planned when you got into a trade. You didn't have any way to get out of the trade to limit to preserve your profits. You didn't understand position sizing, which is how you achieve your objectives. You didn't have a rule-based trading system to guide you, and if you had all of those, you weren't disciplined enough to follow it. Those are the reasons you lost money. And they're what I call mistakes. I like to play poker, and one of my favorite heroes in the poker world is Dan Harrington. Dan won the 1997 World Series of Poker, and in 2003 and 2004, when there were a significant number of people playing poker, he made the final tables. When I read his book, the first thing that stood out for me was a statement he made. Dan says that in the long run, your profits, your results, will be the sum of your opponent's mistakes less your own. And I thought, well, how does it apply to trading? So I developed my own application to trading, which says, in the long run, your trading results will equal the actual expectancy of your system. If you don't understand that, please read a couple of my books, or we're going to have another video that'll explain that. It's the actual expectancy of your system times the number of trading opportunities, less a very important consideration, which is you must subtract some value for each mistake. And I'm going to say it's 3R, or 3 times your initial risk. And right now that's just a PFA number for pluck from air, because I don't know what it really is, but I suspect 3R is pretty close. So let's say your system gives you 0.8R as an expectancy, which means every time you trade, on the average, you make 0.8 times the amount you risk. You make 100 trades, which means at the end of the year, you're going to be up about 80R, which could easily mean you're up 80% if you're risking about 1% per trade. Less the impact, of course, of any mistakes you make. So let's say you make 2 mistakes every month. Suddenly, that's 72R in trading mistakes. Your net result was 80R, but you've got 72R in trading mistakes. Your return is now a very sorry 8R. And chances are, you know, maybe you've turned a fairly good trading system into a borderline system. And if that system went into a typical drawdown, which systems do, you may have abandoned it right in the middle because of the impact of your mistakes. And you gave up a perfectly good trading system, not realizing it was all you and your mistakes. So I like to have my super traders do an analysis of their mistakes. So let me show you one example. This fund manager had one mistake in which he didn't exit on a stop. That mistake cost him 6R. He had 4 exits in which he got out on emotion. That cost him 29.5R. He had stops that were too tight 3 times. That cost him 7.5R. And he had emotional entries 3 times, which cost him 3.5R. So he made 11 mistakes, which cost him 46.5R. Now that's 4.23R per mistake, so that's a little bit higher than my estimate. And at 1% risk, it means those mistakes probably cost him 50% of his account value, or subtracted 50% from his gains, or perhaps turned a good year into a losing year. Those 11 mistakes covered a 9-month period, meaning he averaged 1.2 mistakes every month. And they cost him 4.23R each, which means he made 5.17R per month in mistakes. Now this was a professional trader running a $200 million fund. So what do your mistakes cost you each month? Do you even keep track of your mistakes? I contend that it's very easy to develop a good system, but very hard to trade it without mistakes. And I've documented 3 different types of traders and how they do with mistakes. The first group are mechanical traders. Now these are the individuals who say everything should be computerized. I'm going to eliminate psychology. I'm going to eliminate mistakes because the computer's going to do it all. Well, first, there are built-into mistakes into mechanical trading that the trader doesn't know about, such as opportunities that you can't take because your rules are rigid. But I can remember one of my best friends, maybe 18 to 20 years ago, told me, well, psychology doesn't enter into our trading at all because we're totally mechanical. I said, you could always not take a trade. And about 15 years later, his partner elected not to take a trade. That trade that he elected not to take was the trade that would have made their year. And they went out of business as a fund shortly after that. So mechanical traders do make mistakes. Next we have discretionary traders with no rules. And as far as I'm concerned, this is most people, and everything they do is a mistake because a mistake is not following your rules. And lastly, we have rule-based discretionary traders. These tend to be the best traders when they can trade efficiently. And my finding is that, well, I think I'll save that for you because I've written an article on each type of trader and the kinds of mistakes they make. You can go to our website, vantharp.com, go to the articles section and to download the archives, and you can get a copy of each one of these things and find out for yourself the impact of mistakes. So until next time, good luck and good trading.